What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. In today's episode, we're talking about the recession that's coming. You can run, but you cannot hide. Rising oil prices, they contributed to the last 40 years of recessions. It's also contributed to the stock market peaks that resulted in bear markets in 1973, 1987, 1994, 2000, and in 2008. Do you really think we will be able to walk away unscathed from this? Now, I posted this along with the chart, and the chart was posted on March 4th, along with this tweet. This is the chart. It was a chart of WTIC, which is oil, and we applied a rate of change of 12 months, so a 1 year rate of change here. And what it's calling out is every time that the rate of change reached to around 100 in a very fast fashion, 1987, 1990, the dot-com, financial crisis, and then of course right here. Now, when I posted this chart, oil was going completely parabolic, as you can see. Where are we at now in this updated chart? You can see the rate of change is coming off hard and fast, as well as the price of oil. Okay, when it crosses down through zero, that's going to bring to a negative rate of change, which could show further downside in the cost. So the main takeaway here is, yes, inflation can be coming down, but we're not going to be talking about inflation a year from now. We're going to be talking about the recession. Even today's price action, very dramatic to the downside. It was down 5.69%, breaking from that 85 level, which we've been monitoring very closely, flushing the price of oil down. Now, this isn't the only commodity that's been getting hit. We also have Dr. Copper over here also breaking down from this bear flag and breaking from this prior area of support. You can see the price of copper really went sideways for quite some time. This could be an area of distribution, and then now we're breaking into the decline. We saw a bear market rally. So we'd like to see, if you're bullish the markets, if you're bullish the economy, you'll want to see copper obviously start getting back up on its feet. Also to note, the dollar keeps continuing to push higher and higher. We're going to talk a little bit more about the dollar because the dollar backed off a little bit today, which what? Well, it sent the market upward, right? The S&P 500 had a relief rally. We've been talking about the bounce to come. Don't get your face ripped off. That's nothing new. Now the dollar is backing off. It looks like a bearish type candle where we can maybe take a little bit more of a breather. We talked about the zones yesterday. Now the zone specifically here, I'm looking at DXY, okay? And we talked about the midpoint being 109.28. Now, where did we close? 109.58, which means that there's 1.25% upside, 1.78% downside. So we are right there at the midpoint, but if you pay close attention, we're still above an inclining midpoint here at this given time. So if we start crossing down below it, it might signal that the markets have more room to go to the upside. We also mentioned the S&P 500 midpoint yesterday. We said it was at basically 4,000. Well, where did price run up to? Almost 4,000, 39.79. What does this mean? We're right below the midpoint, which is pointing down, and this has acted as a level of resistance. So if you want to be more bullish, it'd be nicer to see this thing get overtaken and start moving up. But as it stands right now, upside to downside, it's about a 1-for-1. So take your pick. We're moving in to a market that obviously has a lot of news, which we'll get into here. We have the ECB interest rate decision tomorrow. We have inflation rate coming out of China. I don't know if that's going to be all too dramatic there, but we also, on top of all of that, have Fed Powell speaking as well, which, who knows what he's going to say or what he's going to do, but these are market moving events here, especially the ones highlighted in red. Those are considered major events. Now, how did the market do today? Well, we saw a bull market today. We saw a big bear market rally bounce, or whatever you want to call it. Dow Jones was up about 435 points. The big thing to call out here is the 11 sectors. The top performing sector, go ahead and look what it is. It's utilities. And what does that mean? Well, it doesn't mean that good of a scenario for if you're bullish the stock market, right? Yes, we're getting this overextended bounce, right? It was due. We've been calling it out. But the relative strength line, if you just take a look over here, utilities over S&P 500, you can see it continues to hammer out new highs. This is a defensive sector, okay? If it's a defensive sector and it's continuing to outperform the S&P 500 over and over and over again, that's not a good sign overall for the market. So we'd want to see this come off. It has been getting heated. It very well may here in the near future. Let's add on to this with this tweet from May 14th. When the bonds begin outperforming commodities. Okay, so we're using a relative strength line, which I'll point out right here on this chart. Okay, this is when it was posted. I'll give you an updated chart. So basically, when this goes up, commodities are outperforming bonds. When this goes down, That means the opposite. Bonds are, obviously outperforming commodities. Okay. Now, when that happens, so when this happens here, utilities, defensive sectors start outperforming the SPY on a relative basis. Okay, so we have utilities and SPY down here. So basically what this is saying is when bonds are outperforming commodities, when this line goes down, you typically get utilities to start moving up. Okay, but at this point in time, the XLU was outperforming the SPY at the same time that bonds were outperforming commodities. Sorry, commodities were outperforming bonds. Now that doesn't happen often, especially when we measure the correlation, which is the chart right beneath us, okay? When we measure the correlation on this monthly basis, very few times has it reached a 1-for-1 correlation. That was in the dot-com bust, right around that level, and then also leading into the financial crisis. Where are we now? Well, we're still there at a pretty strong correlation overall in the correlation between these two lines. But what we're seeing here is we're seeing utilities really outperform the S&P 500, and we haven't even began to see commodities, bonds start to really outperform commodities. Today, yes, we got a little bit of a bounce, but commodities are diving, bonds are diving too. So this is an interesting interaction, which could be, the early stages of bonds potentially hammering out some sort of a bottom, which would make us potentially move into that stage one of the business cycle. And that's when commodities are down, stocks are down, but then bonds start to move up. Now, we talked about this chart yesterday, the positive divergence that was building on high yield over SPY. Well, we got that move up. You can see right over here, HYG started getting back above that 75, and we start to see the rally, okay? Does this mean that we're going to keep continuing to rip up higher? Absolutely could mean that, but it doesn't mean it has to, right? We were getting prepared for the rally, so what? So you're not shorting in the hole and being that uninformed volume that always takes the trade at the wrong time. So that played out so far. We have consumer discretionary BP chart. I want you to just pay attention to one area of these charts I'm going to show you. It's right here. We talked about overextended areas to the downside and the upside. Look where it's at now. It's working that level off. So what we would like to see is something like this, okay, where this would also come back down but put in a potential higher low, and that would be just a very simple divergence, positive divergence, which could indicate that we're hammering out some sort of a bottom. We still got time for that, but right now it's no longer overextended to the downside. Technology moving outside of overextended. BPNDX, right, the NASDAQ bullish percent chart, working off those overextensions. BPSPX getting back above the 30 marker, working off those overextensions, okay? This is all coming on the back of a summation index that is pointing straight down right now. The parabolic SAR has some time before it starts under clipping, but beneath it, and where this starts turning back around, okay? So we'll continue to watch to see that. As it stands right now, this is a bear market bounce and should be treated as such until we have further confirmation. If we take a look at the summation index here, this is the NASDAQ summation index. The last one was the NYSE summation index. This is below the zero line, so that's not a positive sign. We want to see this obviously start to turn back around and then have the parabolic SAR start ticking under it, which could indicate a trend change. Now, we pointed that out when? We pointed it out right when it did it over here, and guess what happened to the market? It started going down. Then we started talking about this right here, which is the NASDAQ McClellan Oscillator, getting overextended, and guess what? We're starting to see that bounce as it's kind of hammering around right there. We already talked about the calendar, so I'm not going to spend much time on that. And just to kind of sum it up, I want to look at the SPY, the Qs, and the IWM right now. So we got a rally. All right, I want you to notice this. We got a rally, okay? We're above the 5-day moving average. It's starting to flatten out here, but it's still rather in a bearish trend. So it's going to take time. Do not FOMO into anything at this particular given moment. We have the weekly expected move right above us right here at just around 402. That was where this prior price action got all chopped up and we ran into just an area of supply, okay? Now, overall, when you really step back and look at this, we've seen this picture over and over and over. What do I mean? We've seen the rally. We've seen the rally. We've seen the rally. We've seen the rally. Okay, so pay attention to what happens there shortly after. Well, it gets faded. It gets faded. It got faded. Will this get faded, or will we start to once again hammer a potential bottom? Something like that would be nice going into the next week. All right. Now, if we take a look at the Qs, look at how similar this is. So I'll look at SPY Q. SPY, Q, SPY, Q, SPY, Q. They're moving hand in hand right now, just almost a darn near perfect correlation, okay? So you pick what's gonna, you know, what you want to play right now, right? The SPY probably could have went a lot higher if it wasn't for energy being held back in today's trading session, which has got some big mega caps there. But we're above that 5-day moving average right now, okay? So as it stands, right, we want to see this continue to flatten out to go positive. We've already drew that out. We might get a pullback potentially, you know, and then see if it gets back above 300 on the Qs. If it gets above the 300 marker on the Qs, that'd be nice to see, especially if this starts building out like a little bit, you know, a little bit of a base here, and then we start popping above 300. That was something that, you know, I mentioned into the my Patreon this morning where I was looking at 180 earlier on, and you can see here, right, as price was coming up into that area, I thought that, hey, if it starts breaking through 180, it can get quite bullish. And sure enough, we saw a nice big rip to the upside. Very, very controlled, algorithmic type move to the upside. And it's very similar to what we've seen in the past. We've just seen these, you know, big rallies, and they all got faded to the downside, okay? So yes, it's still very early in this process. If we're going to be bottoming, pay attention to these RSIs. They're getting overextended right now. As far as I see it, okay, I'm going to just draw here on the screen. Remember, we talk about this very frequently. The markets, they move between contraction and then they move to expansion. All right, you can see that time and time again. Now, when I say this, right, markets move between expansion and contraction. It could be in the form of any type of pattern that you see, right? As it stands right now, we're looking at, you know, just a pennant pattern or whatever, okay? I'll draw a little area of resistance here, okay? Blue is the price action. We have resistance, and then green, and you can see expansion into contraction, okay? Now, as it stands right now, we are in an expansionary type move. Now, when you are playing an expansionary type move, the only real type of trades that you can do are fading from key levels, playing very tactically. But when you get the opportunity to see tightening happen, what's so nice about this is you can play a very small risk. Say, for example, if this is a bullish breakout, you can play, you know, your risk on breakout. This would be your risk, and a possible move of, let's say, you know, back up to the swing high over here. So when things are expanding, you get to obviously minimize your risk. You get a back into risk for potentially a nicer size reward to the upside. And right now, as it stands, all of these are in a period of expansion. So what you want to see is price to tighten back up to give us a better risk to reward. Other than that, we got to continue to be tactical. Hope today's episode helped out, everybody. See ya later.